Our next speaker is our very own Vice President of Public Relations. Toastmaster Tim Linger's speech is from his second Path and Pathways, Presenting Mastery, Level 4, Managing a Difficult Audience. The scenario: Tim is teaching an educational class in front of a live audience. The attendees are getting restless. Tim's speech is titled, "Hold on, I'm talking." Here's our Toastmaster Linger.
All right, Tim.
Thank you for having me speak today. Thank you all for attending. The way I like to give my presentations is to get audience involvement. So when I speak on my subject today, I'd like for you to, if you have a question, if you have a question, please just raise your hand and I'll answer it as I go, rather than wait to the end of the presentation to answer it. If you have a question, let's talk about it. So, a little bit about me. I'm a certified senior advisor and have been for over 20 years. I've been in the retirement business for 35 years. I've been a certified HECM specialist for more than 5 years and a certified reverse mortgage professional for 7 or 8 years. And in fact, if I can brag about myself, I have been a CRMP for 7 or so years, and I'm only one of 165 in the entire nation. So whatever questions you have, I most likely can answer it. So today's topic is about the FHA HECM, or what most people call a reverse mortgage. So what is a reverse mortgage?
Mortgages are bad. You gotta take it away from the young generation. My inheritance.
So we're going to address that. But first, let me explain what a reverse mortgage is. First of all, a mortgage is a HECM. What the heck is a HECM? A HECM is a home equity conversion mortgage. It's FHA's safe type of reverse mortgage. So let's talk about this. A mortgage is a mortgage is a mortgage. All right, we can call them FHA loan, a VA loan, a conventional. Those are mortgages, and all of us know basically what a mortgage is. It's where you borrow money from a bank, you make monthly payments for upwards of 30 years, and the bank puts a lien against the house, right? That's a mortgage? Right. So a reverse mortgage is no different than traditional financing, except, are you ready for this? Payments are optional. Mortgage payments are optional. Now there's rules. It's an FHA loan. You must be 62 or above to have one of these, so you could call it a retirement loan. But we can talk about all the bad things, and we will. But a mortgage is a mortgage is a mortgage. So all the things that you've heard on the street, with the bank's going to take the house, eventually you're going to owe more than it's worth, whatever you've heard on the street, remember this. Payments are optional. Make a payment, your balance goes down. Don't make a payment, your balance goes up. It's the safest loan in America. Now, before I go to chapter 2, any questions?
That negative amortization, it seems to me like you're just adding to the balance and eating it all up and eating up this old senior's equity. What kind of crazy is that?
Yeah. Wow. Well, in the words of Dan Wallace, what's your point? I'm a bad man. So to address that, I hear this all the time. If you do a reverse mortgage, eventually you're going to owe more than the house is worth. Negative amortization. But here's my response to that. In retirement, cash and cash flow is the two most important things. And your health, of course, right, Roy? So having an optional mortgage payment is a game changer in retirement. So like any mortgage, you'll get a monthly statement from the servicer. It'll say your interest for this month is X number of dollars. You as a retiree, 62 and above, have the ability to make a payment or not make a payment. So once again, negative amortization. If you choose not to make a mortgage payment, then balance goes up. And if you don't make a payment two months in a row, the balance goes up again. 5, 10 years in a row, the balance is higher. Now the theory behind this, and what actually is reality, is that homes increase in value. Not all years, some of us remember 2010. Not all years, but on average, homes increase at 4% a year. So FHA is willing to allow a 50% equity loan. So if the house is worth $300,000, they're willing to lend $150,000. So your balance is already low enough. So even though the interest is accumulating, if you choose not to make a payment, then the balance increases less fast, if that's the right word. The incursion of the interest and the value of the house increasing usually does this. The value of the house increases faster than the debt. That's what's supposed to happen, and in most cases, that is what happens. Any other questions?
Let's say like, for an inheritance situation, if your parent ends up owing money on a house, like they haven't paid off their mortgage yet, and then they end up passing away, what happens to that inheritance? Does it go towards the bank?
Okay, that's a fantastic question. So let me give you a real example. I'm a veteran. I can go out and buy a house today for 100% financing. I have no equity, right? 0% down, I have no equity. Tomorrow I pass away. Who's going to inherit my house? The bank?
The bank.
What does my will says? My will says that my 2 children inherit the house. There's no equity in it, so they may not even want it. On the other hand, what if the house increases in value overnight? Because sometimes people buy houses for less than what they're actually worth. So my children have a decision to make. Now we're talking about a VA loan right now. Do I sell the house and keep the profit, or just let it go back to the bank? Because there's no money in it if it's 100% financing. Or what if it's going down in value, right? Do the kids even want it? So my point of this is with any mortgage, regardless of the type of mortgage, reverse or forward as I call them, the heirs are going to inherit the house along with the mortgage attached to it. The heirs will make a decision if they want the house or not, depending on the equity. So on a HECM, on a reverse mortgage, a HECM once again is home equity conversion mortgage. On a HECM, if the house goes up in value, the kids are certainly going to want to inherit it and sell it or keep it and keep the profit. If the value is not there, because this is an FHA insured loan, as I mentioned, the safest loan in America, because this is an FHA government insured loan, if there's ever a time that the value of the house is lower than what's owed, because we have a housing recession, whoever inherits the house, not the government, not the bank, but whoever inherits the house has a decision. Do they sell it and take the equity? Do they keep it by refinancing? Or if it's not worth what's owed, they can give the loan back, give the house back. This is, once again, the safest loan in America. Optional mortgage payments, you own the house, you can will it to your family, it's your house. You can sell it in your lifetime.
I have a question.
Roy?
So, I've heard this, you can correct me if I'm wrong,
You're
that the
wrong.
banks,
Next.
that the banks, when it comes to make that decision about the house for the heirs, there's so many hidden costs that the children are going to say, no, we'll walk away, and the bank will make an enormous profit because of increasing it only 4% a year, and you say, they've gone up 20% a year. Is that correct? The banks are out to get the property?
No, you're incorrect. All right, well, thank you. Oh, wait. Real quick, that is not true. The bank does not want the property. The bank lends money. The family's going to inherit the property. They're going to sell the property. They're going to refinance it. It's their property. The bank is not going to make any money off of the sale of the house. They will make money off the interest because that's how loans work. Let's take a 2-minute break. We'll see you in part B. Thank you very much.